Last week, interest rates ran up quite a bit in North America, mainly because of stronger than expected employment numbers out of the US and higher energy prices because of the conflict in the Middle East. And this caught a lot of people by surprise because after the 0.5% cut from the Federal Reserve in September, everyone got ahead of themselves thinking that we were going to see some pretty aggressive cutting coming out of the US in the months ahead. And these numbers and the conflict kind of threw that out the window. So what does this mean for Canada and interest rates in Canada, and how's that going to impact people with a mortgage? Well, these are not strong Canadian numbers, these are strong US numbers. So the fact that interest rates aren't coming down as much as originally expected, this is going to dampen the Canadian economy even more. So this means more downward pressure on Canadian inflation and the Canadian economy, which means eventually we'll see lower rates in Canada, but nothing goes in a straight line, so this doesn't surprise me, this uptick in rates short term. But I think, looking out farther down the road, this is going to have a huge dampening effect on the Canadian economy, and it'll eventually have the same effect on the US economy. So longer term, you can expect that these gyrations, I guess you could call them, in interest rates are going to continue to put downward pressure on the North American economy. And we can still be hopeful in that we will see lower interest rates ahead in the next year. Anyways, tomorrow we got inflation numbers from the US, and the big one this week is Canadian employment on Friday. That is going to be the number that determines whether or not the Bank of Canada cuts 0.25% or 0.5% on October 23rd. Take care.